You're buying a rental and two loans are fighting over it. In one corner, the conventional loan, the one your bank pushes on everybody. In the other, the DSCR loan, the one serious investors swear by. Pick the wrong one, and you either overpay on your rate, get flat out denied, or slam into a wall when you go to buy your fourth or fifth property. So which one actually wins? Today, we're putting them head to head, round by round, and by the end, you'll know exactly which loan fits your deal. Let's get into it. Quick note, this is education, not financial advice for your situation, and loan terms vary by lender and change over time. My numbers are examples to keep the comparison clear, so use this to understand the trade-offs, then talk to a licensed professional, that's what I'm here for, about your actual deal. First, let's meet our two fighters. The conventional loan is the default, the one backed by Fannie Mae and Freddie Mac. To get one, the lender qualifies you. Your income, your job, your tax returns, your debt-to-income ratio. It's the loan most people already know. The DSCR loan is different. DSCR stands for Debt Service Coverage Ratio, and instead of qualifying you, it qualifies the property. The only real question is whether the rent covers the payment. No tax returns, no W-2s, no personal income at all. Two completely different philosophies. And which one you pick doesn't just change your rate. It changes whether you qualify at all, how fast you close, how you hold the property, and how many you can ever own. So this matters. Get it right, and the loan just fades into the background while your portfolio grows. Get it wrong, and it quietly costs you tens of thousands, or stops you cold at property number 5. Let's see how they stack up, round by round. Round 1, qualifying. This is the biggest difference of all. A conventional loan digs into your personal income and your debt-to-income ratio. If you're a W-2 employee with clean pay stubs, that's easy. But if you're self-employed, or you write off a lot on your taxes, or you already carry mortgages on other properties, your income on paper might not cut it, and you get denied. The DSCR loan doesn't care about any of that. It looks at the rent. If the property cash flows, you qualify. Round 1 goes to DSCR for investors and the self-employed, and to conventional for the steady W-2 borrower. Real quick, if this head-to-head is helping you, do me a favor and tap like. It genuinely helps a small channel like this get shown to more investors who need it. Okay, ding ding, round 2. Round 2, the rate, and here's a myth I get to bust. A lot of people assume a DSCR loan comes with a much higher rate. It doesn't. In today's market, DSCR rates are actually very similar to a comparable conventional Fannie Mae loan. They're competitive, so that old idea that you pay some big premium just to skip the income documents, that simply isn't true anymore. Round 2, call it a draw. The rate is no longer a reason to avoid DSCR, and that's a bigger deal than most investors realize. Round 3, how many can you get? This one's huge for anyone serious about scaling. Conventional financing caps you out. Fannie Mae allows a maximum of 10 financed properties, and honestly, it gets painful well before that, with bigger reserve requirements and tougher pricing once you're past your fourth. Most investors don't realize that squeeze starts so early. By your 5th or 6th deal, conventional can simply run out of room. The DSCR loan has no such cap. As long as each property stands on its own and cash flows, you can keep going. 10, 20, more. Round 3 is a knockout for DSCR if you're building a portfolio. Round 4, speed and paperwork. A conventional loan is a documentation marathon. 2 years of tax returns, pay stubs, bank statements, the works, and a slower underwrite. A DSCR loan is light, no income docs, mostly just the property, your credit, and your reserves, so it often closes faster. A conventional file can drag on for weeks. A clean DSCR can close in a fraction of the time. And when you're competing for a good deal, that speed can be the difference between winning it and losing it. Round 4 goes to DSCR for simplicity and speed. Round 5, how you hold it. Conventional loans are made to you personally, in your own name, and trying to move that property into an LLC afterward can trip something called a due on sale clause. DSCR loans are built for investors, so you can usually close right in the name of your LLC, which is cleaner for asset protection. Round 5, DSCR. Round 6, the fine print. Conventional loans almost never carry a prepayment penalty, so you can refinance or sell whenever you want for free. Many DSCR loans do carry one, especially in the first few years. Round 6 goes right back to conventional. Round 7, the down payment, and this one surprises people. On a single-family rental, the two are basically even. Plan on about 20% down either way, but on a 2 to 4 unit property, they split. A conventional loan jumps to 25% down on a multi-unit, while a DSCR loan often stays at just 20%. So if you're buying a duplex, a triplex, or a fourplex, DSCR can actually take less cash to close. Round 7, a tie on a single family and a slight edge to DSCR on multifamily. So tally it up, and you might think DSCR wins on points. But here's the real lesson, and it's the whole point of this video. There is no universal winner. The right answer is the loan that wins for your situation. Conventional wins when you've got clean, provable W-2 income. You want the simple, familiar process with no prepayment penalty, and you're buying your first rental or two. DSCR wins when your tax returns don't show enough income. When you're self-employed, when you're scaling past a few doors, or when you want the speed, the LLC, and the flexibility. And here's the pro move that smart investors use. They do both. They use conventional loans for their first few properties while their income still easily qualifies, and then they switch to DSCR once their property count or their tax returns make conventional impossible. You ride conventional as far as it'll take you, then DSCR carries you the rest of the way. These two loans aren't enemies. They're tools for different stages of the same journey. Knowing which one you're holding and exactly when to switch is honestly half the game of scaling a portfolio. Let me make it concrete with two quick examples. Meet Sarah. She's a teacher with a steady W-2 paycheck, buying her very first rental. For her, conventional is the obvious play. She qualifies easily, and she locks in that lower rate. Now meet Mike. Mike's self-employed, his tax returns show almost nothing after all his write-offs, and this would be his fifth rental, one past where conventional starts to get ugly. For Mike, DSCR isn't just better, it's the only door that opens. Same goal, two completely different right answers. And notice neither one is doing it wrong. They're just standing at different points on the same path. So how do you pick? Just ask yourself 3 questions. 1. Can my tax returns actually prove enough income to qualify? If the answer is no, lean DSCR. 2. How many properties am I planning to own? If it's more than a handful, lean DSCR. 3. Do I just want the simplest, most familiar route with no prepayment penalty, and can I qualify the traditional way? If yes, lean conventional. Answer those 3 honestly, and the right loan picks itself. This is education, not personalized advice. So talk to a licensed professional, that's what I'm here for, about which loan actually fits your exact deal. If this finally cleared up DSCR versus conventional for you, do me a real favor and hit like and subscribe. This channel is still small, and every like and subscribe tells YouTube to put this in front of more investors trying to build something real. It's free, it takes 1 second, and it's the single biggest thing that keeps these videos coming. I'll see you in the next one.